Right now, the UK housing market is in serious trouble, despite the UK government declaring victory in the war against inflation, changing the way they calculate GDP to make the economy look stronger than it actually is, and the Bank of England holding interest rates for the first time in the last 14 meetings. It is clear the UK property market is now in a confirmed downtrend, with all of the leading indicators for both the housing market and the economy accelerating in the wrong direction. So today I want to zoom out and recap everything that's been going on over the last few months. Crunch the numbers and talk about what the next 12 months is going to hold, and see if we're actually now entering an era of opportunity for the contrarian investor. And if you hang around to the end, I'm going to give you a killer property strategy that I'm using right now but not seeing anybody else talking about, that will help you find property deals that buck the current market trends. Now, despite their best effort to spin the data, the latest HPI from Halifax shows that the drops in property prices are actually accelerating year on year. And when we average it with the nationwide, we're about 5% down compared to this time last year. But the reality is that only now are we entering the period of maximum pain for homeowners, as over 100,000 people every single month are still coming off cheap fixed rate debt of 2% or less. In fact, between now and the end of 2024, over 1.6 million people are going to come off fixed rate mortgage deals, leading to a significant mortgage shock that compounds the already hard to deal with cost of living crisis. And this shock isn't just going to go away anytime soon. According to the latest Bank of England stability report, the proportion of UK income spent on mortgage costs is going to be rising into 2026 and beyond. And although the report forecasts that the peak is going to be less than previous peaks, that completely ignores the fact we are in a cost of living crisis, and the fact that the last two previous peaks come off the back of a property boom, not a property crash. And as these mortgage costs go up, they're inevitably going to feed into the inflation figures. So whilst the government slaps itself on the back and congratulates themselves for fixing inflation, the reality is right now we're seeing inflation come down because the shock of the energy crisis and the oil crisis of 2022 has now fallen out of the figures. And if we actually take a second to look into the real data, we can see that the cost of owner-occupier housing and rent is increasing on a month-by-month basis. Now, this is not good news for anybody. Now, if this rise continues, it has the potential to cause secondary inflation effects, and that's going to mean either more interest rate rises or the interest rates are going to stay higher for longer. And as the cost of servicing debt and mortgages go up, even with the strong nominal wage growth we've seen over the last 6 months, due to being hit on every front with other affordability issues, it's pretty obvious that people are going to be struggling to service their debt. We can already see this filtering into the arrears data, with homeowner mortgages in arrears going up by over 23% year on year. But even more startling is the rate of arrears in the buy-to-let sector, with landlords now having the double whammy of Section 24 tax and rapidly rising interest rates. Incredibly, the amount of landlords falling into 2.5% arrears or more has spiked by 126% year on year to date. Now, Section 24 is actually causing double pain for landlords, because as well as not being able to offset their interest costs against profits, as those interest costs go up, it's going to mean that more people are going to be paying tax on actual losses. For the baby boomer investor generation who have likely built significant equity over the last several decades, why would you hang around to battle eroding profit margins and increased regulation when you could take the opportunity now to sell up, release your equity, and retire comfortably? So we are now seeing an exodus from the buy-to-let market from several demographics, which is putting the market into a vicious circle. With buy-to-lets now being sold off, even before we consider the factor of an increased supply into the housing market and what that could do to property prices, the number of properties available to rent are decreasing steadily, and this is causing a huge supply and demand imbalance in the private rental sector. Couple that with the fact that the landlords who are sticking around are having to whack up their rentals to cover the increased cost of servicing their debt, and we find ourselves in the midst of a rental crisis. Over the last 18 months, we've seen consistent double-digit rental inflation. And as this continues to feed back into the inflation data, we continue to find ourselves in this vicious cycle. So finally, let's have a look at what's going on with the economy. The Blue Book 2023 introduced a new methodology with how we work out GDP in the UK, and surprise, surprise, all of a sudden the figures just got a lot better than they were a month ago. Now, what's interesting about this data set is the new methodology matches the previous pretty much exactly up to the point of COVID. And it's only after the pandemic where suddenly we seem to be doing a lot better. Regardless of this small piece of spin, there's no denying that since COVID, our economy has stagnated. And whilst we are technically avoiding recession, when we look at the heartbeat of our economy, it's pretty much flatlined. And this is despite the largest schedule of quantitative easing that's seen more money pumped into the economy than 2008 and Brexit combined. Now, up to now, the labour market has remained super tight with a shortage of workers. But when we look at the leading indicators, we're starting to see job vacancies fall off and unemployment tick up. Now, to give this balance, we are still sitting at historically low unemployment rates, but it's the trends that really matter. And it's also widely recognised that interest rate rises take 12 to 18 months to actually filter through the system. So right now, we're actually only really feeling the effects of 2022's interest rate hikes. And the current interest rate we're at won't really be felt until the end of 2024. And this is assuming, of course, that we don't get more rate rises from here. So when we step back and look at the data, it paints a pretty bleak picture. And right now, the housing market appears to be paralysed. I've said for some time that we're in a race right now with interest rates coming back down again and Brits running out of money. Because one of the key factors that is giving the housing market resilience right now is there's still a lot of liquidity and money in the system. Now, after COVID, when everybody was chucked a load of free money for sitting around at home and not working for a year, this found its way into a lot of people's savings accounts. But now, with the reversal of policy and quantitative tightening, this is rapidly draining away. But right here, right now, in October 23, whilst there's still cash reserves in savings accounts and millions of people on cheap fixed rate mortgages, a lot of people just don't have to move right now. So it's no massive surprise that housing transactions are falling, and last month saw a level of mortgage lending that was 30% below 2019. The question is, what happens when liquidity runs out and people are forced to sell? So it's all lost and we're about to melt down and turn into a third world nation. Well, I've maintained since I started this channel that we need 3 major factors to happen to see a full-blown property meltdown. The first of these is affordability, or lack of it, and we're definitely ticking the box here as we stay in high inflation, a cost of living crisis, and the mortgage shock still building. Now, the second is negative equity. This is really a byproduct of property prices coming down and accelerates a crash when people have to sell, mainly due to the third factor, which is unemployment. And so here we come to the crux of it. Right now, although all the leading indicators are going in the wrong direction, we're still far away from being in a deep recession with massive unemployment. Now, the interest rates rising as quickly as they've done, the system is bound to creak. But the question is, will it break? I've always called this property market correction completely different in structure to 2008 and more similar to the crashes at the end of the 70s and the 80s. But there is a big differentiating factor with what we're seeing now, and that is the unemployment rate. Because with those 2 previous crashes, we saw unemployment spike into double digits, and we're a long way away from that right now. Now, should we see the economy snap and unemployment spike up, it's inevitable with high interest rates, we're going to see a significant property market crash. But what if the economy doesn't snap? What if it just maintains its status quo, or it actually is doing better than we think it's going to? And the Blue Book 2023 is not just some big conspiracy dreamt up by Sunak and his cronies to stay in power for another 5 years. Now, to answer all of these questions and try and predict what's going to happen over the next 12 to 18 months, I want to look at real or inflation-adjusted house prices. And when we do, we can see that there's already been a significant price correction. And for me, these real house prices are the actual metric we should care about as investors, because it's the real value of the asset you're holding. So despite the resilience in nominal house prices over the last 12 months, when we look at real house prices, we can see that right now they're looking extremely affordable. In fact, we're fast approaching the same level as when the market bottomed out following the financial crisis of 2008. And when you take it further to left, we're actually at the same real house price as 2002, which was the time just before the property market went ballistic in the noughties. And with real house prices in such steep decline and nominal wages so strong, right now, we're seeing a complete rebalancing of the house price to earnings ratio, which is one of the key metrics that people use to assess affordability. To read into this more, I recommend you read the Resolution Foundation report Peaked Interest in conjunction with this Bank of England staff working paper that talks about the long-term effects of interest rates on house prices. I'll link to them both in the description. Now, their conclusion is that house prices could correct by up to 20% for every 1% change in persistent real interest rates. And with a Bank of England long-term base rate modelled at 3.5%, they forecast that the house price to earnings ratio would settle at about 5.9 times. Now, one of the issues we have trying to work out where we are right now is that the official house price index is lagging by almost 9 months. But when we look at Nationwide's latest data set, we can see that the affordability curve is coming down quickly. And so if this trend continues, that I believe we'll see a bottoming of the market in nominal terms a lot earlier than many of the doommongers are predicting. However, I also think we'll see a continued correction in real house prices for longer than people think, unless inflation suddenly drops off a cliff and overshoots targets. Now, when we combine all of these factors, we find ourselves in an interesting scenario. In real terms, house prices are becoming better value every single month. And as rents continue to rise, the yield on property is becoming more attractive for investors again. Now, for sure, this needs to be approached with caution, because I still feel we've got quite a long way to run on the correction. And I also struggle to see a scenario where interest rates start coming down before summer 2024. And even then, the reality is they're probably going to take years to settle down. But they will come down at some point, and when they do, it's likely to give oxygen to the pent-up demand that's in the housing market. Now, I'm not going to predict when this is going to happen. Nobody can. But one hypothesis might be that nominal house prices trough at the end of 24, before stagnating for some time as we see a continued decline in real house prices. But as the saying goes, be greedy when others are fearful and fearful when others are greedy. There is fear in the air right now, but I also feel that we're seeing an increased asymmetry in the risk-reward ratio in the medium to long term as real-term house prices continue to get cheaper and are the cheapest they've been for 20 years. And if you are looking to invest like a professional and create momentum by adding value and create a huge return on capital, then actually the average house price in the UK are fairly irrelevant anyway, as we're not using the market to add any value in the first place. And so I believe we're entering a period of accumulation, especially for those who have cash reserves to deploy and don't care about interest rates anyway. Now, the next few years could just facilitate one of the greatest wealth transfers we've seen in decades, as many property owners and investors jump out just at the wrong time. And if you're looking to be on the right side of this, I want to help you with some strategies to help you navigate the complexities of the current market. We've recently seen an explosion in an industry called PropTech, which is technology to help us in our property business. One of the tools I've been using and I've now wrapped into all of my trainings is called Property Data. This tool gives you up-to-date property market analytics to help you make better decisions and uncover the hidden gems. Within seconds, you're going to have all of your local market data at your fingertips, data that would have taken weeks, if not months, to research properly. With this tool, you can immediately find the spread of values in your area based on either property size or, what's more relevant, to common size all properties using the price per square foot method. As well as that, we can immediately hone in on what the current rents are going to be and combine the two to find out what our yields are going to be on any property. Now, you can also use this tool to work out your local area demographics, as some people end up buying property lemons just by buying one street too far. Now, I spent a lot of time recently working out how to use this tool to find the best deals in the area and stumbled across a beautifully simple strategy to find undervalued property. I call it value arbitrage. All you have to do is bring up this chart which shows all of the on-market properties in your area distributed by a price per square foot and size basis. Then all we need to do is find the outliers, work out why they're priced below market value, how we can add the value to get up to average or exceed the price per square foot in an area, and start our negotiations. Like this property that I found in 30 seconds in Southampton, which you can see is being marketed significantly below the average price per square foot in that same area. When we look at the property, we can see it's a stunning building, grade 2 listed with 16 HMO rooms in it. Not only is it a beautiful building, but you can see that property data is showing that it's 31% below the average price per square foot in the area. And I'd hardly say this is particularly below average property. So let's have a look at what the rents are in the area. Coming to this tab, we can see that we've got an average rent of £700 a month for a double with an ensuite and £555 a month for a double with no ensuite. Now, looking at this building, I'll be confident again to get above the average. So let's take £650 a month for a double with no ensuite. Now, this gives us a gross yield on the purchase price of almost 14%. And even if we strip off 25% for utilities and voids, we're still in double-digit net yield. Not bad for a beautiful grade 2 listed building on the south coast of England, all found within 30 seconds of logging in. Now, I've put a link to property data in both the description for this video and the pinned comment. And if you follow that link, it's going to give you a 2-week free trial for you to have a play around with it yourself. I suggest you go and check it out right now and work out how you can use it to be on the right side of the greatest wealth transfer we're going to see in a generation.